All right, everyone. Good evening, and thank you for showing up tonight to the Fall in Love with Your Dream Home with the Scanlon Home Team. I am Kristen Scanlon, one of the co-founders of the Scanlon Home Team. We are excited for you to be here because honestly, buying a home and falling in love with a home is a process. It's not something that is always easy. Sometimes you're going to have highs, sometimes you're going to have lows. There's a lot of emotions involved, and we are excited to be partnering up with Frank Verga of Embrace Home Loans because he is the pieces to our puzzle that we all need, right? Because if you're not buying a home with cash, odds are you're going to need to get pre approved with a bank and understand that process. And whether you're looking to buy a home in 6 months, a year, 2 years, 3 years, 4 years, it's good to educate yourself on the process so that you can prepare yourself, save, budget, plan, fix your credit, and do whatever you need to get done so that the process could be seamless for you. We have Jackie Tutavin, who is our showing agent of the Scanlon Home Team, and she's based out of Suffolk County on this call. Kaylin, who is my sister and the other co-founder of the Scanlon Home Team on this call. And we will bring lots of experience and ideas and answer all of your questions that you have for us tonight. Frank, if you want to say a little bit about yourself, how long you've been in the business, share a little bit about what you do, we'd love to have you do that.
Sure. Well, thank you very much, guys, for inviting me on. I'm always so happy to be a part of this with you both and be able to support you guys. So, as Chris kind of mentioned, I play a very integral part in the process of buying a home. Right when it comes to financing a home, I've been doing this now for 17 years. The company I'm employed by is Embrace Home Loans, and we are one of the nation's largest direct to consumer mortgage lenders. So we have grown our business, and I've grown my business because I'm thoroughly invested with my buyers when it comes to buying a home. And we're going to do everything that we can to build the right mortgage plan out, show you what your options are in terms of financing a home, and then also, most importantly, make sure that we're buying a home in the right price range, right? Making sure that we're not over budgeting, we're overspending, and also that we're not, undercutting ourselves, right? So 17 years of doing this at Embrace Home Loans, and I've been ranked amongst the top 100 mortgage professionals in the country in the last 5 years. So, any questions that you guys have, I think Chris and Kay mentioned it earlier. You can throw them in the chat box. I'll be on all night. So if you guys have questions afterwards, I'm happy to answer any, personal related questions or questions just, generally speaking regarding the purchase of a home.
Thank you, Frank. We're always so excited to have you. You've been a wealth of knowledge to so many of our clients, and they're all raving fans. So we do appreciate all that you do. And like Frank's one of the, like us, right? He'll do whatever it takes to get the job done. And we really like to align ourselves with those people that do whatever it takes to get the job done, because real estate, especially in this market, has been a bit challenging. There's going to be some really highs and lows in the buying process. It depends where you're buying. If you're looking to buy in Queens, the market is not as competitive as if you're looking to buy in Long Island. Inventory is very low. There's a lot of buyers. There's a lot of bidding wars. There's a lot of long lines at open houses. But it's really about listening to us coach you through the process, being strategic on submitting the offers, having a loan officer like Frank to call the listing agent or to call the sellers to really sell our clients to them to get our offers accepted. And we always go that extra step and extra mile to do whatever we can to try to get you into your dream home. We do tell people sometimes you're going to hear a few no's, but it takes a few no's before you get that yes. And sometimes a no might seem really, really disappointing, but sometimes it's really redirecting you into what's really meant for you. I'm a believer in what's for you will not pass you. So talking a little bit about home ownership, I'll get started in the process. So what basically happens is a lot of times clients or friends or family will say, hey, my friend's looking to buy a house in Queens or Long Island. Can you help them? Of course we could help them. Whether you're looking, a family member, a friend, we're always happy to help. And really the first step in the process is learning what the affordability is in your home search, right? Because first step is meeting with us, doing a home buyer consult, and then learning what amount can you afford to buy. because we don't want to take you out to homes that are 600,000 when you're really in the 400 to 500,000 range. And then you fall in love with the $600,000 home and you compare every other home to the $600,000 home, and it can't be yours. We don't like to deceive people. We don't like to set unrealistic expectations. We really need to know that budget. The other piece of the puzzle is with COVID, especially the year that we've been having, is being pre-approved is important to go to see homes, because that's really your ticket to get into homes. A lot of agents, a lot of sellers want to see people's pre-approvals before we even could get an appointment. And that's really just protecting the listing agent, the buyer's agent, the sellers, because they don't want people randomly going in the homes. Less is more in this market, because homes will get sold if they're priced right. So what do you need for a pre-approval, Frank? Typically, if someone came to you or came to us and was like, hey, we want to get pre-approved, and we're like, Frank, we have this wonderful buyer, what do they need to submit to you? How do they get pre-approved?
That's a great question, Chris. So there's two different types of documents when a buyer starts to look for a home. The first would be a pre-qualification, and a pre-qualification is not something that I specifically do. It's more of a very informal document that a buyer will collect from a lender or a broker by basically just having a conversation with them, right? So, hey, this is what I do for a living. This is what we're thinking our budget would be in terms of down payment, and we feel that we have good credit, or here's a credit karma or some sort of free credit report that they ran. And based upon that information, a pre-qualification letter can be drafted for them and given to their agent. There's not a whole lot of digging. Leaves a lot of room for error when no documents in terms of pay stubs or W-2s are provided. So then we like to do something called a pre-approval, right? A pre-approval is going to do a little bit more digging up front, a little bit more legwork. We look for pay stubs, your last two most recent pay stubs. We'll look for your last two W-2 forms from your employer. And then we're going to look for any bank documents to source your down payment. Where would your down payment money coming from, whether it be checking or savings or retirement accounts. So we do want to make sure that we have the right pieces of the puzzle, so that when we send you out there with your agents, we know when we tell you, hey, $600,000 with $15,000 in taxes, we know that's the right budget. We know it falls for what you're going to qualify, falls into what you're going to qualify. But more importantly, we also know that it's going to keep your monthly payment exactly where you want it to be, exactly where you budgeted for. So there's a little bit more legwork up front for a pre-approval than a pre-qualification, but ultimately it will be able to nail down precisely what your price range is, and also what your tax amount should be, to keep you in a place not only that you qualify for, but also a place where we know we're within your monthly budget. One additional item that I do want to touch on that we do at Embrace, that a lot of our buyers are having more success with in the last 2 years, being that such a competitive market, we'll actually take a pre-approval and take it a step further. Now that we have your loan documents, we're going to have you e-sign the application, and we're actually going to formally issue a loan commitment. So this is when your file now becomes from a pre-approval to an approval status, where we take your loan, we submit it to an underwriter, have your loan documents reviewed, and that underwriter will now issue a loan commitment. It does strengthen your offer when you're competing against buyers that have pre-qualifications and pre-approvals that haven't gone through the process yet of having their loan formally reviewed by an underwriter. And now Kristen and Kaylin are able to make an offer on your behalf with a commitment letter. So it does show almost as a cash buyer, because your financing is already in order. Your credit scores have been run, your documents have been reviewed, and now you have an actual commitment letter. So it's kind of a pre-approval on steroids. It does require that you're a little bit more invested in the process up front, but by doing that, you will set yourself apart from other buyers that haven't done the due diligence and maybe only have a pre-qualification or a pre-approval. So buyers that do want to go through that process, they'll make me aware of it. They'll make their agents aware of it. And then your agent will say, hey, this is a great buyer for our, what we could call an approved to move file, where we're going to issue you a formal loan commitment. So we do have two options. We have your pre-approval, and then we have your loan commitment option, which is what we call an approved to move.
Now, Frank, I know you mentioned the magic word credit, right? How does credit impact pre-approval, interest rates, and all of that? Because I know I get that a lot from
Sure.
first home buyers, like, hey, my credit score is this. Will I get pre-approved? Will I not get pre-approved? And how does that process work behind the scenes, especially with a mortgage?
So there are several different types of mortgages, and every type of mortgage carries a different credit requirement. So an FHA loan or some sort of a government insured mortgage like a VA loan will actually carry a lower requirement for a credit score, where in that case you could actually go down to a 580 credit score, where a conventional loan will carry a higher credit score requirement. Um, it's really important that we run your credit before issuing you a pre-approval. One, not only to determine price point, but also to determine the right loan for you. You may be under the assumption that your credit scores are not as good as you think that they are, and when we run your credit, we find out that they are, maybe better than you've you know been led to believe, and that may put you in a higher price point. It may also put you in a different um, loan product. So it is something that I think one of the most common questions I get asked is, oh, if I have my credit run, will it hurt my credit? And that is not the case. There is nobody that's sitting behind a desk right now waiting to drop your credit scores because you're being a consumer and trying to buy a home. The CFPB, which is basically the Consumer Protection Financial Bureau that oversees um, consumer credit, allow you to get to have multiple credit inquiries over a 45-day time frame, and it's all treated as one type of inquiry. So they're not gonna hurt you. They're not looking to drop your credit scores. Now, if you've had multiple different types of credit score inquiries, it can vary your scores by a couple of points. But if you've managed your credit well, if you manage your inquiries well, one or two mortgage inquiries are not going to have any sort of drastic impact on your credit score. So what happens is a lot of buyers are under that misconception. They start saying, well, I have Credit Karma, or my credit card send me my credit scores. Those are not the same type of scores that when a credit report is run to obtain a mortgage. When you have to understand, when you're looking to borrow $200,000 or $500,000 in terms of a mortgage, that credit report is going to be much more detailed of a report. So the things that you're getting in the mail are what we call consumer-based scoring models. Credit Karma, freecreditreport.com. They do a limited search. That's why they're free. They usually sometimes will only score off of one credit bureau and not all three credit bureaus. So it is very deceptive if you try to use those scores to qualify for a loan. This is the biggest purchase of your life. It's one of the bigger financial decisions of your life, and it should be treated that way. It should be, done the right way. Not, hey, I got some stuff in the mail that said my credit score is this, and now I'm going to go spend $500,000 on a house. We should be invested, mutually invested, in the process to buy a home, and part of that is to have your credit run, and ultimately it will determine the price point, but also the type of mortgage plan that's right for you.
So now someone in that box asks, what if you have good credit, but you have student loans? And I know that usually typically impacts your debt to income ratio.
So a lot of my buyers are first-time home buyers, and a lot of my buyers, almost all of us, have student loans or had student loans at one point in time. It's not uncommon. I have seen hundreds of thousands of dollars in student loans on a credit report, and I've had people that are within a couple months of paying theirs off. It will factor into your debt to income ratio and ultimately what you qualify for. How it does, it depends two things, right? It depends what type of loan you're applying for. It also depends upon, do you have payments on those student loans? Are they deferred student loans? If they're deferred, depending upon if we're taking a conventional type mortgage and depending upon what agency, would kind of get a little more granular now. But for instance, if we went with a Freddie Mac, there's two mortgage securitization portals, or two mortgage agencies that secure mortgages that are made, and it's Fannie Mae and Freddie Mac. Fannie Mae requires that we use 1% of the outstanding balance on any mortgage, on any student loan debt that has no payment. So if you have $30,000 in student loan debt and there's no payment, because a lot of student loan payments right now are deferred with everything that's been going on with the pandemic over the last 2 years, we would have to carry about a $300 payment in your debt ratios. On the conventional side of being a direct lender, we have the flexibility to make these decisions. We can go Freddie Mac, which actually only requires a 0.5% of outstanding loan balances. So if our buyers qualify, we would only have to carry a $150 payment, which the lower payment lowers our debt ratio, gives us more purchasing power. And that's the same thing on FHA. FHA only now requires a 0.5% of any student loan balance that has no payment associated with it. So it will have an impact on qualifying when we start factoring in other debt. How much it would come down to are there payments and how much are the balances on those student loans if there are no payments, so that we can figure out how much we have to carry. And the reason that happens is because Fannie Mae and Freddie Mac are what we call under conservatorship. Basically, they are overseen and basically are have government oversight. They're basically government-owned agencies. So what happens is, so are your student loans. So the federal government is always concerned, well, if we give a mortgage to somebody that has outstanding loan debt, we want to ensure that not only the student loan debt can be afforded to be repaid, but so could the mortgage. So that's why, even though there's no payment on it, and the clients say, well, I don't have a payment on it, I'm not obligated. You are obligated at some point in time. You will be obligated to repay that. And they want to make sure, the federal government wants to make sure that when that time does come, you're not going to have to, be delinquent or be over your max debt load now with the mortgage that you have in your name. So they are always going to err on the side of caution. They're going to calculate a payment on those student loans, and they're going to make sure that, hey, with that payment, worst case scenario, and the mortgage payment, will they be in a position where they can afford to make both? Because the government doesn't want to be on hook for any loans that they've made to anybody, whether it be federal student loans or mortgage loans.
That's
Awesome.
really helpful. One of the questions I know too, before we get into like the showing process and the next steps, because obviously all of this is like the mortgage part of it, right? The beginning of this process. Someone had
Absolutely.
asked, what's the lowest amount that you could put down? So I'm going to preface this before Frank answers. It depends what you're buying, right? If you're buying a house, a condo, or a co-op, it depends. If you're buying a co-op, most likely it's anywhere from 10 to 30% down, depending on the co-op complex and their requirements. But regarding house and condos, Frank, what's the lowest amount down payment that you could put down on a house? And then I'll share a little bit how down payment impacts your offer strength in this market.
Absolutely. Absolutely. And Chris, exactly that, right? So when we build out a financial plan, it's not always about, hey, the type of loan or the type of credit history. It's also the type of property that you're looking to purchase. As a first-time home buyer, there are options out there to put down as little as 3%. So we do offer a conventional mortgage for first-time home buyers, which is as little as 3% down. As a down payment. So if we had a $300,000 sales price, you could put that as little as $9,000. Now, there are additional or applicable costs when you come to buying property. Those would be called closing costs. So we'd have to make sure that we have enough budgeted to cover both. On an FHA loan, you could put that as little as 3.5%. So there are some really great first-time homebuyer programs out there right now that allow for reduced down payment options. So 3% down on a conventional, 3.5% down on an FHA loan. Now, Kristen's going to go into, though, with you about the strength of your offer, right? If we're competing against other offers that have 10 and 15 and 20% down, it does make it difficult to have an accepted offer in this market when we are competing against buyers with stronger offers. And it brings me back to one of my earliest statements about that may be the right time that we say, hey, you know what? I think if I invest more time in my pre-approval, invest more time in my mortgage, that we take that loan and now we go from pre-approval to commitment, it will help strengthen your offer in this market when your sellers or the seller's agent now say, hey, you know what? They have a loan commitment. Yes, their down payment maybe not as much as other buyers, but they've done the work. They've done the due diligence. They have their loan approved. We have a commitment letter in hand. It does at least help entertain the conversation a little bit longer when our down payment may be not as much as some of the other buyers that we're competing with.
Yeah, because we see that a lot, especially with offers. Kay, if you want to highlight a little bit about that.
Yeah, so I think it shows your motivation in this market. So basically, like going that extra step that Frank said, it's showing the buyer's motivation that they truly want the house. And I think that does mean something to sellers when they are looking at all of the terms that they're being offered. In this market, it's very easy to see 20 offers on a house. So to make yours stand out, we really have to get creative with it. And I love that Embrace Home Loans does offer that program where you go the extra step up front and then you save time in the end.
Because the other thing is too, right? The highest offer is not always the best offer. Terms
Mm.
matter in the offer that you're going to be putting into the home. Um, Before I guess we get into putting the offers in and all of that, what I'm going to do is you guys got pre-approved. Now the next step is getting you out to showing. So this is where I'm going to pass it off to Jackie, where we get pre-approved, we do the buyer consult, and then Jackie gets the blessing of taking you out to show you on appointments and scheduling appointments. So she's going to share a little bit of what that looks like.
Hi guys. So basically, a lot of people, especially when we're working with first-time home buyers, have never seen homes before. So it usually takes a few appointments for us to kind of get in the groove of what we're really looking for. And in more cases than not, I have seen it many times before where someone will know exactly what they think that they want, and then they see a house that is the complete opposite, and they get the butterflies, the tinglies, the whole 9 yards, and it is their house. So basically, sometimes we always say, listen, the first house can be the house that you see, or it can be the 100th house that you see that can be yours. But I definitely always tell all of our buyers that it's important that you don't really make it too difficult. Don't cut off too many options. Always be open to a lot of alternatives, because you never know, what certain towns or certain homes can offer you until you actually see it in person. So basically, when we do start this process and we do look at homes, I like to say, all right, pick a few different homes in different areas so we can kind of get an idea of what you're looking for in terms of location and in terms of the type of house. Because a lot of people don't know the type of houses, whether it's a ranch or if it's a cape or a high ranch or a colonial. A lot of people don't realize that there's different styles, and they don't realize that they have a preference until they see it. So I usually like to bring the buyers to a few homes, get a feel. After, I would say, the third or fourth house that I see with a buyer, I can already tell the type of style that they like, whether it's the wife, the husband, the mom, the sister, the grandma, the whole thing. So it's definitely important that you give it a few tries before you really start to see a pattern in what you're looking for. Sometimes we do look at houses that are vacant. Sometimes you look at houses that have people still living in them. So you do get a variety of those, and you can kind of take your time in some houses over others. I do like to say that we don't really like to look at more than 4 or 5 houses in one day, only because it can kind of all mash together at some point. But it is a really fun process if you allow it to be. You can definitely picture yourself. Maybe this house was everything you wanted, but you're not crazy about the layout of the living room, and that's what's most important to you. So it's definitely a fun process, but if you keep, in mind of what the big picture is, it's a lot of fun.
Yeah, so Jackie's like an intricate part of like helping show you the home, set up the appointments, getting you out there, getting you into the homes. And like the other thing is have fun with the process, because sometimes, like Jackie said, when you have your mind set on one thing, it might not be, right? And there's sometimes you walk in the first home that you see, you fall in love with. It was like one of Jackie's first buyers. He went to a home, he fell in love with it, got the accepted offer. It was like one and done. And then some people, you get knocked down, you get a few no's until you get that yes. Sometimes, I mean, we had one client, Kay and I, last year, that they were selling something to buy. So when you're selling something to buy, it's a little tough, right? Because it's a chain reaction. So it was a little harder to get their offer accepted in that process, because their purchase was contingent on what they were selling. And if that property that they were selling didn't go through, that means the purchase wasn't going to go through. So there's so many different angles that we could look at this, but we are all here always to help. Like Jackie is very resourceful. She lives out in Suffolk. Kay and I live in Queens, but we also do a lot of business in Nassau County and in Brooklyn. So like we're literally all over, and we're always there for you. So once Jackie gets you out to seeing the homes, and you guys really discuss what you're looking for, how many bedrooms, how many bedrooms, the style home, what lot size, all of that stuff, then you start going to see the homes, you fall in love with a home, you submit an offer for a home. What do you need to submit an offer from a home? Because Kaylin's usually behind the scenes, getting those offers in, getting you into the next step of the home buying process.
So what do you need when you're submitting an offer? Well, you totally need that pre-approval or that loan commitment that Frank was talking about earlier. But what else do you need? Well, you need to know your terms, right? So we get really creative at the Scanlon Home team to make your offer stand out from most. So we'll go over some comparables in the market that have recently sold. We're also looking what's actively on the market. And also, if you showed up to the open house and there was a line of 40 people, guaranteed, we have to be very competitive with our offer. So we're going to go over all of the comparables and then come up with a suggested range. We'll never tell you the offer amount because we want you to feel comfortable and confident in the decision that you're making when you're submitting the offer. So we'll give you a suggested range of where the comps are, and then ultimately you'll come up with the ultimate number. We'll give you some tips and tricks in creative ways when submitting offers, just to make yours stand out from some others that we've done and worked on in the past with some lucky numbers. And what we'll do is we'll attach your pre-approval with your offer amount. Now, you also have a down payment amount. So you have a down payment at contract signing, and then you also have the rest of your cash at closing. So you typically evenly divide it, but depends. Everyone's situation is very different. So we'll go over all of your terms. And when do you want to close? Do you want to close in 60 days? Or do you want to give the seller a little bit more time to move out and give them 90 days or 120 days? We've seen it all in this market to get your offer super creative and stand out from the most. The more flexible you are, the better, because the seller also usually has to find another home. Unless they have another home lined up already, typically they may need more time than you might have thought that you've had to give. So you do want to be lenient with the time frame and be a little bit more flexible than we have in the past. So we'll submit the offer for you, and then obviously we follow up with the listing agent to let them know that we submitted the offer, and then we'll wait to hear back until they're all reviewed. Once they're reviewed, congratulations, you have an accepted offer. Now what? Chris, you ready?
Yeah, so when we also start the process, which I forgot to share, we have a vendor list that we provide with you of all different vendors. You have, our loan officer, our inspectors, our attorneys. There's multiple vendors that you're going to need throughout this process. So once your offer gets accepted, they're going to ask you, do you want to do an inspection? Some buyers will waive an inspection because they really, really want the house and they don't want to lose the opportunity of possibly getting outbid if somebody else comes see it between the time their offer gets accepted and the inspection. And then most buyers will have an inspection for educational purposes. When there's a multiple bid property, it's going to be really hard to negotiate if anything comes up in the inspection. It's more educational so that you know what you have to do in this house, especially with multiple. Obviously, there's certain things that may come up where the sellers will say, hey, I'll fix that, or hey, I'll give you a credit for that. But we see that few and far between in this market. So we'll give you a list of inspectors. Unless you have your own inspector, then you could utilize your own inspector as well. You get an appointment with the inspector. He goes out, he inspects the home, kind of highlights any imperfections or anything that he might see wrong structurally, mold, termites, stuff like that, because these are things that are important, especially when you're buying a home. You don't want to feel like you walked into a lemon in a project unless you're buying a flip or a gut job renovation home that you plan to do it the way, however you want, right? So now you do the inspection, you get the report back, you're like, I'm good. I want to move forward. I'm ready to go. So now what happens next is a deal sheet will go out from the listing agent to the seller and buyer's attorney. So it's important to have a real estate attorney. We highly recommend you hiring a real estate attorney, not a divorce attorney or not, a corporate attorney. You want a real estate attorney who's doing this day in and day out, because there's so many different things that could go wrong in this process when it comes to title, CO. Real estate attorneys do this day in, day out. They know the process. They know what they're doing. They'll get you to the finish line. We have tons of great resources that we work with there as well. When they get the contracts, they review the contracts. That could take, from accepted offer to contract signing could be anywhere from 3 days to 7 to 10 days, depending how quick you move, your inspector moves, the attorneys move, and how quick you get there to sign it and put the deposit. So once the attorney reviews, gives us his blessing, he's like, you're ready to sign. The buyer signs first, leaves the deposit at contract signing. Then that attorney sends it to the seller attorney, and then the seller sign, and then you're fully executed in contract. Once you're executed in contract, the contracts go to your loan officer so that they could begin the final stages towards ordering an appraisal and getting your clear to close. Now, in this market, this is something that we see quite often, over ask offers. competitive offers. Now, it has to appraise. And what we do is we run comps to bring to the appraisal of stuff that recently closed. As long as stuff had recently closed that is at ask, over ask, or similar price range, you should be good. But Frank, what happens if the home, say, sells for 600, but it only appraises for like, say, 570? What would happen on your side of the loan? Would they lose the loan? What goes on?
So that's a good question, and something that we saw. We saw this in the beginning parts of 2020, because what happened was we saw such an influx of buyers that came out, especially on the island, right? People that were leaving the city and buying in Nassau and Suffolk County. The home prices didn't catch up to the closed sales at that point, right? We had buyers that were almost all buyers were overbidding at that point, and until those homes have sold and set a new precedent for those areas, we were seeing some short appraisals, just based on timing, right? Just based on things not catching up to each other. We're kind of through that for the most part right now, but it is something that occasionally does happen. So if we use a $600,000 purchase price and we said, hey, this thing appraised at 570 or 575, it does not kill the deal by any stretch of the imagination. Now, what we have to start evaluating is, one, what is our loan to value is based upon the loan that we're taking out against the value of the home, not the purchase price. So we have to start to evaluate, okay, well, now that the loan to value changed, is it still within program guidelines? Okay. So let's just use, for argument's sake, a $600,000 sales price, and we were putting down 20%. So we had $120,000 down payment, a $480,000 mortgage. Even if the home appraised at 570 or 575, it's still well within the guidelines of qualifying for a loan. The loan to value has changed. The loan to value is now higher, which may incur some additional costs in the mortgage, such as mortgage insurance or PMI, but it's still within the program guidelines. And what we would do as a mortgage planner is start to figure out the least path of resistance, right? And more often than not, when the buyer does have a good down payment of north of 10% or more, a short appraisal by $5 or $10 or $15 or $25,000 more often than not has very little impact or negative impact on the buyer. So everybody's loan scenario is going to be different. Somebody with a 3% down scenario compared to a 20% down or 15% down scenario, there is a higher risk there when a home under appraises, because at that point, then we may have to come up with additional down payment money, or we may have to turn to the seller and see if there'll be a renegotiation of some sort. So every situation is handled differently. The loan type, the down payment, all those things are going to factor in to whether or not a short appraisal has a real negative impact, or is it ultimately a deal killer. I would say in my last 2 years of doing this, and probably close to 700 or 800 buyers that we've worked with, less than 10 times or 15 times do we actually have a short appraisal that ultimately killed the deal. You still have a willing buyer, you still have a willing seller, and more often than not, there's still a deal there to be had, right? Maybe it may be in conjunction with the buyer bringing a little bit more money to closing. It may be the seller reducing the sales price a little bit. In some cases, nothing has to be done, right? The buyer maybe waived their mortgage contingency because we knew moving forward, the buyer had a sizable down payment and that there wasn't any real way they can get hurt. So to get that offer accepted, we waived that contingency. But ultimately, when you have a willing buyer and a willing seller, and really, the other, piece of that puzzle is really, good agents and a good attorney, a really, good team in place, there's a deal to be had there. And we almost always could find a solution. If, you have someone that's not playing well and you have an attorney that's not playing nice or something, then sometimes you have things spin out and maybe it's a deal that doesn't close. But I would say more often than not, even with a short appraisal, there's a deal to be had if the buyer really wants a place and the seller really wants to sell it.
Yeah, we had like one deal out of the 63 that we closed last year that didn't close because of an appraisal issue. And
It's very far in between.
Yeah, we were like really transparent from day one that, hey, we have multiple offers, inspections for educational only. If the appraisal comes out short, listen, there's ways for attorneys to write in that they're waiving the appraisal, or they'll waive up the appraisal to this like a X amount, right? Just to protect the buyer. Some buyers will move forward depending how badly they want it. Some still want the appraisal contingency in the offer. so it really is a case by case scenario. This particular buyer thought, okay, if it underappraised, I'm going to negotiate with the seller. And the seller was like, nope, we had multiple other offers. And the seller's actually got a higher offer right now on the table. So, sometimes you take a step back to take a step forward. But these are just things in the buying process that it's important for you to be educated on, because a lot of times people don't understand it. So now once the appraisal comes in, Frank, what are the steps to getting a clear to close so that we could get to the finish line?
So that's a great question. I'm just going to cut you off though one sec, Chris. So we spoke on two occasions tonight regarding the kind of the pre-approval on steroids, right? We talked about our approved to move, about going into that full commitment, right? Because it made you really look like a strong buyer when you compete against other offers. Something that we've rolled out here at Embrace over the last 90 days or so that we've had a lot of traction with, and it, once again, this is not a broad stroke. This is not in all instances. It is really for the conventional buyer. It doesn't matter if it's 3% down or 20% down. But when our buyers go through the steps of getting a commitment letter, and they're invested in the process, so now they've e-signed their documents, we've submitted the loan to underwriting, that loan comes out with a to be determined property address. I give it to Jackie and Kristen and Kay, and they have a copy of it. So when you're out there touring homes and seeing properties you want to make an offer, they're going to do so with the commitment letter. Myself and a few other people here kind of brainstormed in this tough market and said, hey, there's got to be something else that we can do to kind of strengthen our buyers, right? To assist our agents from having to take buyers out for weeks and months and not having any luck. And what we came up with is what we call our value guarantee. Our value guarantee works like this. So Kristen or Kay, Jackie, you have your commitment letter for your buyers, and you say to me, hey, Frank, we're going to go see this property on Saturday or Sunday. What is the max that this property would qualify for the value guarantee? Or let's say, hey, we have to, we got to be at 625 on this 590 home. I run that address, and within 20 minutes, I can tell you if it meets our value guarantee. If it meets our value guarantee, it basically means that you're going to make your offer with no appraisal contingency. We're not saying that we're not going to need appraisal. We're saying that we're moving forward regardless of what the house appraises for. We will not go back to the buyer to ask for a larger down payment. We will not go back to the seller to renegotiate. If that property meets our value guarantee, you're going to make the offer on that property with a commitment letter and with no appraisal contingency. And ultimately, regardless of what that house appraises for, we're moving forward at the initial terms of that contract. So we call that our approved to move plus. It's new. We've had success with, I can give you probably 6 instances where we've had buyers that were putting down between 3 and 5% that went all of 2020 and half of 2021 without finding a home. All 6 of those buyers have either closed or now are in contract on homes with the same terms, just having a commitment letter and now being able to make an offer non-contingent upon appraisal.
And that's huge, right? Like I said,
Yep.
like waiving that appraisal contingency is huge. And
It's a game changer. It's a game changer.
There are some people that, are contractors and they're well versed to waive an
course.
inspection. But if you're a first time home buyer, we don't recommend you doing that because, yes, will it make your offer stronger? Yeah. But at the same time, we would never want to put someone in a bad situation. So Frank has that program, which is an amazing program.
Yep.
More buyers had that sooner. But it's great
It's a game
that
changer.
you have it as a resource, especially what's going on in the market. Because Jackie's out there. She sees the lines. I mean, at these open houses, some weekends, Jackie, how long are the lines of the open houses and how long have you waited just to get into a home?
I think the first week of January with that TikTok that I made, I was in line for almost 2 hours and it was like 20 degrees outside and my buyers were there and they didn't want to be anywhere else. They wanted this house, and that's how motivated people are right now.
Yeah.
Yep.
And even last weekend, Kaylin was at open houses and there was snow on the ground. People were still out. They didn't care. They were still going to see houses, right? So this is the market that we're in. So now, once your appraisal comes in, if you have the proof to move, which is fabulous, Frank, I know that you're issuing the commitment ahead of time for, most of the buyers, but what's the next steps to getting to the closing line? Like, what do you need for a clear to close?
That's great. So what happens is when a mortgage gets approved is what we call a conditional approval. So there are loan conditions attached to that commitment letter. that have to be satisfied before the lender is going to clear your file for closing. Okay. A lot of the times it's things that you are it's very easy for you to obtain, right? Maybe an updated pay stub, it may be an updated bank statement, it's a title report from your attorney's office. So your attorney's going to order a title report. We're going to have a copy of that title report reviewed. Your homeowner's insurance has to be in place, right? Now that you own this asset, you want to make sure that it's properly insured. So a homeowner's insurance. So as we collect those conditions will go back to underwriting. Those conditions will be cleared. And when those conditions are cleared, us as the lender will reach out to all parties on the transaction and let them know that the file is cleared to close and that we're free to go ahead and schedule. So, the buyer, I think some of the best advice I can give, going through this process myself, doing this now for the better part of almost 17 years, organization is probably, one of the top ones, right? Being able to have access to your documents and your personal documents and making sure that they're clear, concise. You really don't want to leave any question marks. You don't want to have any gaps in things. Start making large deposits without speaking to your lender. So organization is one. Two is communication, right? I want it with my agents. I want it with my buyers. Before you do something that may cause you to qualify or to not qualify or delay a deal, I want to hear from you first and see if we can figure out a solution. So it may be, a large deposit. It may be moving money around that can't be sourced. It may be leaving your job and going to start another job. I mean, these are things that you're asking a bank to lend you a lot of money, right? We're not talking about a credit card or anything like that. We're talking hundreds of thousands of dollars or more. And we want to make sure that we're staying within program guidelines, but also that we're having the communication not to stall out a deal, because we do have dates in the contract that we need to withhold to, application dates, approval dates, when your file is, on or about closing dates. So we want to make sure that we're continuing to move the ball down the field. And without communication, it's almost always what causes the delay, right? The buyer does something without speaking to somebody, and then things start to go sideways, right? Or what I call start to spin out. So communication, organization, and the third is really the team, right? I need to have accountability for myself, but I need to be able to hold the buyers accountable. And by having the right team in place and having access to your mortgage lender, your attorney, your realtors, all the people that are working in your best interest, to me, I always feel, and I always find, come to find out that those are the buyers that have just the best transaction, right? They have the most success. They're always the happiest buyers because everybody's working for their goal, right? We're all in this to get you to the finish line as pain-free as possible. And I've reached out to Chris and Kay on items that I've needed to get a file cleared and vice versa. And we work collectively with the attorney that they use. And what happens is when everybody's working towards a common goal with anything in life, there's always greater success there. And I feel as the buyers that, put the right team in place, that everybody plays nice, everyone gets along well, those buyers always, in my 17 years of doing this, always have a better transaction and a better experience than the buyers that, I found somebody online and I found a friend of an attorney who just got his, just passed his bar exam and he's going to charge me $300. When I start hearing things like that, I start to cringe because I always know how things are going to end up, and this is not a place when you're spending $500,000, $600,000, $700,000 on a house. And after interest over 30 years, it's well north of $1 million investment. Do you want to start cutting corners and start, being, penny wise, pound foolish? We want to make sure that you're putting the right people in place that you trust as your professionals. You're not going into this saying, well, I got to save a couple $100 on my legal counsel on buying this $600,000 house. I mean, that's just not where you want to save your money. So to me, organization, communication, and obviously the team that you put in place are the three most important things when it comes to buying a house and being successful while doing it.
And we've seen it even getting accepted offers, right? Your team who you work with matters. Like, hey, Jackie, we have relationships with a lot of the agents in the industry. So having those friendships and relationships definitely help, because if they know your work ethic, they know that your team that you're working with is going to get the job done. They're going to be your advocate in speaking to the seller to get your offer accepted. Like, we had an offer that we submitted to a property, and this client like lost multiple bids, but she really loved this house. And like literally when we submitted the offer and it was Frank Verga, the agent's like, I've done many deals with Frank. Like he's amazing. I'm gonna see what I could do to get this like offer accepted because I know the job's gonna get done. So who you work with always matters. You know, think of it as you're buying the most expensive thing in your life. Like if you're going to the doctor, you're going to do research on the doctor. Like work with professionals that add value to your transaction and not are just doing it for a quick buck of a transaction, right? Yeah, it's getting paid and you know making money and this is our living is important, but the experience that those agents create for you is a lot more important than getting our paycheck because for us what we do, we put our whole heart and soul into it. You know, we really, really do. The next step is now once you get your clear to close, your attorney's going to work with the seller's attorney, the buyer's attorney, and the bank attorney to schedule a closing. But in that process, the attorneys make sure the title's clear. If the survey's not on file, they get the survey done. Sometimes we've seen where surveys have had discrepancies and we've had to get notices signed. I've gone to houses to be like, hey, can you sign this fence is on your property? I mean, as realtors, we'll do whatever we have to do. We'll go take pictures of backyards to show the attorneys like, hey, this is where the fence is. This is what we do. If we have to do it, we'll get it done. Another step, right, once you're getting clear to close and the attorney schedule the closings, what we do recommend early on, and I forgot to mention this, when you're at your inspection, bring measuring tapes, bring all the things that you need to do to measure the rooms, stuff like that. If you have a contractor, maybe bring them to the inspection because there's no guarantee that the listing agent or the sellers will let us in for a second, third, fourth, fifth, sixth time to get these measurements to let contractors in. Because with COVID, some sellers and some listing agents are a little bit more selective of how many times you're allowed in and out of a house, but we'll give you like checklists and ideas of what to do throughout the whole process of where you need to be because it happens. Sometimes you're like, oh, like I need to know what size furniture. But speaking of furniture, Frank, there's going to be a list of things that you should not do. So when you get your offer accepted and you're under contract, there's a lot of things that you should not put on your credit card during this process because there is a good chance that you will not get approved for a loan. Furniture, especially if it's a hefty cost, is going to be one of them. Frank, what are things not to do while you're in contract of a home with a mortgage?
So when applying for a mortgage, it's not a one-time application. It's an ongoing application. And what happens is we are monitoring your debt, not in terms of your existing debt. We've already verified that when we ran your initial credit report, but an unreported debt monitoring happens basically up until the day that you close. And we will get alerts when your credit is being pulled because we have to make sure, one, that you're not applying for another mortgage, but you're also not applying for a car payment. The most common outside of a car, you know, people sometimes will have a lease that's expiring before calling. Once again, go back to the communication. Before calling their mortgage professional, we'll go out and just lease a new car. And I cringe when we get those alerts because now I have to ask you what it was for. And it's not as simple as I'm just going to return this lease. The dealerships don't allow you to do that. So it's, you know, the cars are very common, one of the more common ones. And it goes back to the communication. The other piece is always, once they're in contract, is a lot of buyers will start to shop for furnitures. And a lot of weekends, there's a lot of incentivized sales, and people will go out there and open credit cards to save 20% or 30% on furniture from Bob's or Raymore. I mean, you name it, I've seen them all. And we send emails. We send weekly emails out to our buyers, especially before the weekends. Do not go car shopping. Do not apply for furniture cards. Like, we send them out religiously. And I'll send it out on a Friday, or the team will send it out on a Friday. Saturday, we'll get an alert that they were at, you know, Bob's and applied for a Wells Fargo Bob's card. And we have to then get the payment. We have to get all the documentation. We have to add it to your credit report. And we have to make sure that this is not going to impact you buying a house. And ultimately, we've had buyers that either had to go and get a gift from mom or dad or family to pay off this furniture because it took their debt ratio that was at a 45 or 46 or 47%. And they had $300 or $400 payment on this new furniture that pushed them over 50%, and they didn't qualify. So any new debt is a big no-no, especially if you're not communicating with myself, right? So new cars, return of old cars and getting a new car, any sort of furniture shopping, any sort of appliances we see, any new credit that's being issued. Now, you could use your existing credit cards. We do not repull credit within 120 days. So if we're inside of 120 days, we're not repulling credit. So you could use your existing credit cards and continue to pay things. You obviously want to, avoid any slow pays or delinquencies or late pays, collection accounts, things like that may pop up. But you could use your existing debt the way you would for the most part. But the new debt is an issue, right? And that's the other part of it would be going back to the employment piece, right? Sometimes we have buyers that leave jobs, and that's, I would prefer them ask me first, and if they could wait, that's one thing. But we've had buyers that go from W-2 pay stub employees, and now they go start a business, or now they go to a 1099 where they're responsible for their own taxes and insurance, which is like virtually being self-employed. Without a 2-year history, they do not qualify for a mortgage. And we've had buyers make those decisions without calling me, no matter how many times we told them not to. And sometimes it will jeopardize the fact of them being able to buy a home. So new credit being one, new car payments, any extension of new credit being issued to you, and then obviously any changes of career choices, jobs or anything like that, professions, you want to speak to your mortgage professional before making those decisions.
Awesome.
Interesting too, because we had a buyer that was like, "Oh yeah, I co-signed a loan for my cousin. I didn't think it was a big
Right.
deal." I'm like,
Same
"What?"
thing.
Like
Same thing.
literally, it
Yep.
was literally a week before we were about to close, and like our attorney he goes, "Do you know what he did?" And I'm like, "No, like he didn't tell us." So sometimes people do what they want to do instead of what they're supposed to do. So it's always important, like if you think you're like not sure about like you're doing the right thing, ask
Call.
us.
Always call.
Frank,
Always call.
like that, we always bounce ideas off Frank before our clients do certain things too, because we want to make sure, like, hey, like if we go up this high, is it going to push them out of their budget? Blah blah blah. Like, because interest rates are going up a little bit. So when interest rates go up, your spending power actually goes down. But what we're also seeing is prices are not going down on homes, right? So if you're buying a house at 500,000 at 3% versus 450 at 4%, you're still paying more in interest over the life of the loan for the 450,000 at 4%. Frank could always go through those calculations and payments with you, but a lot of times people don't realize a 1% in interest increase reduces your buying power probably by 10% at least. So Frank,
That's
how are
correct.
the interest
Yep.
rates going? Do you want to just touch upon it briefly?
Yeah, so we are in a raising rate environment right now. But when we talk about interest rates increasing, it's not because the Federal Reserve is coming out saying, "Hey, we're moving interest rates." That does not have a direct correlation to mortgage rates, right? So when the Federal Reserve, and we see publications and things in the news that say, "Oh, the Federal Reserve are raising rates." They are not raising interest rates. What raises interest rates right now, or the concern on interest rates, one is inflation, right? So we have the cost of day-to-day goods, right, are increasing, and because of the fear of inflation, what has to happen now, the Fed needs to kind of increase rates, overnight lending rates, credit card rates, things like that, to kind of cool off inflation a little bit. The actual raising of those federal funds rates may actually benefit mortgage rates right now for the short term. Last year, for the most part, we were in the low to mid to high 2% range. Rates got as high as roughly 3.75% the end of 2021. We are somewhere in the mid 3% range now, so rates have cooled off a little bit. The one thing that we're concerned with, and that we'll continue to monitor in my industry, is the Fed has been the biggest buyer of mortgage-backed securities out of anybody, and they have been artificially keeping rates low by buying mortgage-backed securities, close to $100 billion a month in mortgage-backed securities. So by buying mortgage-backed securities, they have basically added liquidity to keep mortgage interest rates artificially low. The problem is now they have a huge balance sheet. And if they start to shed that balance sheet, which basically means is when a mortgage gets paid off, the Federal Reserve gets that money. But right now they're still reinvesting that money into other mortgage-backed securities. So by buying other mortgage-backed securities, interest rates still remain very low. And an interest rate in the mid 3% is still an all-time low interest rate. If they start to shed that balance sheet, which basically means they're not reinvesting the money now from those mortgages that are getting paid off. So someone that has a home, that sells their home, pays off that mortgage, that money goes back to the Federal Reserve. If they don't take that money and invest in other mortgage-backed securities, and they shed that, they don't reinvest it back into mortgage-backed securities, we're going to see interest rates really move higher. So, it's something that we need to watch. Interest rates are under pressure for sure, because once again, the biggest buyer of mortgage-backed securities is now saying that they're going to taper or buy less of them. And until other buyers step in, and there'll never be enough buyers to make up the difference of what the Federal Reserve is doing, we will see pressure on interest rates this year. I do think that we'll probably get somewhere close to 4% by the end of March, early April. I do think that we'll cool off and we'll probably end up settling somewhere between 3.4 and 3.75% through the rest of the year. So it will be a little bit of a roller coaster. A lot depends upon what the Federal Reserve does with their current balance sheet of mortgage-backed securities. Still a great rate. Unless something happens that's kind of unforeseen, I think the days of, interest rates in the twos are long gone. But still an interest rate in the mid 3% range is still a super competitive interest rate when someone's willing to extend you $300,000, $400,000, $500,000 worth of credit over 30 years without a penalty to prepay it at a 3.5% rate or something like that. It's still very cheap money, but something that we need to keep an eye on, because the one thing that we suffer with here, on Long Island and Queens and Brooklyn, there isn't a whole lot of new construction, right? So we're seeing interest rates move higher, but we're also seeing home prices still move higher, right? Because we have a lack of inventory. So we're not getting any real breathing room like other demographics across the country, because where they can continually build, where home prices aren't on the same path or same trajectory that they are here. We're seeing interest rates move higher, but we're also seeing home prices move higher, because what happens is now as interest rates move higher, anybody that was kind of on the fence and says, hey, I may or may not want to own by the end of 2022 or 2023, have now started to jump into the market, causing a bigger pool of buyers, driving up prices that much more when they start making offers $50,000, $60,000, $75,000 or more on homes that are listed. So now they're driving up prices that much further, and they're not getting any real relief with interest rates, because interest rates are moving higher as well. So we are kind of like in a catch-22 right now. To me, educated buyers that are ready to pull the trigger, that have done their due diligence, that have taken the steps to put themselves in a position and get their documents in order to make an offer. Right now, they kind of, are in the better spot than other buyers that are kind of like, waiting to see what will happen.
Yeah, and Frank, you brought up an interesting thing, right? Because usually January, February, March, we see a whole flux of buyers really excited. It's on their vision boards, like new year, new home, new goals, like either they're ready to downsize, ready to buy their first home. And it's interesting because we're also seeing a lot of people saying, hey, I think I'm going to rent for a little bit to save and this, that, and the other thing, because they're getting priced out of homes. Like, so in the past, when interest rates have gone up, home prices have gone down, right? Because there's this correlation. Interest rates low,
Yep.
prices go up, they could afford more. But now
Yep.
interest rates are going up, home prices are going up. It's really impacting the way people are able to buy and have their buying power. So
No doubt. No doubt. And the other part of it, and this is just my own personal opinion, where I think this market is headed for buyers that are still on the fence. I think everybody at some point in time, wants to own a home, right? I mean, that's just, quote unquote, it's been the American dream always, right? Is to own a home. I don't think anybody says I'm going to rent forever. The issue that we have here on the island and in the 5 boroughs, is we've had so much refinance activity and this is just my personal opinion. We've had so much refinance activity over the last couple of years. And that's where a buyer or a homeowner will refinance the mortgage that they're in for better terms, right? For either a lower interest rate, for shorter term. So maybe they go from a 30-year to a 20-year, or 20-year to a 10-year, 15-year. The problem is that so many of those homeowners have done that. And when rates start to increase right now and home prices are increasing as fast as they are, it's going to make less inventory, because now people are not only married to their home, but now they're married to their interest rate and the loan that they're in. right? Nobody wants to leave their 15-year loan that they just took all these years off the loan. They have a 2% interest rate. And now to say, well, now I got to get a 4% interest rate on a 30-year loan for a home that's, maybe a $600,000 house, but I got to pay $700 for in this market. So when those buyers aren't trading up, it's not leaving a whole lot of inventory for first-time home buyers or buyers that are also looking to trade up. So to me, the artificially low interest rates have and will only cause further inventory issues when people say, you know what, I may want more room and I may want a bigger home or a house with a pool or whatever they may want, but I'm having a hard time getting rid of what I have in terms of an interest rate, in terms of a loan, where I could maybe pay this thing off for 10 or 15 or 20 years and then start over at a 30-year at a much higher rate of interest. They're almost married to their loans right now. And I think this is going to be a problem moving forward because once again, we don't have anywhere else to add any new homes, right? We have what we have here. And if people say, you know what, I'm just going to kind of stick it out here, and maybe I'll do some work where I'm at. Maybe I'll take a second mortgage or a line of credit and I'll make this house the way I want it. I'm just not going to give up the loan that I'm in to start over and get into a bidding war with 50 other first-time home buyers in this market. So when people aren't selling, it's going to continue to have supply and demand issues.
Yeah. So these are things that we're seeing across everything. And if you guys have questions on this, it's definitely important. I'm going to just take you through the next quick steps to the finish line and then opening it up for questions because I want to make sure we have time for you too. So basically we get clear to close, the attorney schedule closing. Once we have a closing date, you'll say, hey, these are the closing dates. What's next, right? So that's when we then say, hey, when do you want to do your final walkthrough? So if the closing's on Monday, do you want to do it Sunday morning, Sunday afternoon, Monday before closing? So we have to coordinate your schedules, our schedules, the seller schedules, and the listing agent schedules. We do a final walkthrough. One of us, Kristen Kay or Jackie, will be there with you. And we kind of just guide you through the process of what the final walkthrough, you want to check outlets, make sure all the appliances are working, the windows are opening and closing. Everything in a final walkthrough should look like or be similar like to the last time you were in the home. Obviously, there's going to be no furniture in the home, but you want to make sure there's no huge holes, dents in the walls. If something's not working, you bring it to our attention. We have a conversation with the attorneys. This way they could speak at the closing table or negotiate a credit or the seller to fix it or repair it at that time. Another thing that sometimes does happen is what's called post-possession. So if a seller is selling a home, but they're not ready to close on their home or they need to find something. We just had this last week where our seller, the buyer needed to close because their child support payments were going to increase in the next couple of weeks and they weren't going to get their loan approved, but the seller wasn't ready to move. So we did a favor. We closed quick. Now the seller has 30 days post-possession, which means basically the seller gets to still live in the home, even though they closed on the home and they got the funds for the home, but they have to still leave the house the way it was. So the attorneys will hold money in escrow to make sure that no damage was done. So if you're on the buy side and the seller has a post-possession, the attorneys will protect you by keeping money in an escrow account. We do the walkthrough, everything gets checked, you get to the closing table. Typically, sometimes like the agents will be there, but with COVID, we're frowned upon almost for being at the closing table because you have the bank attorney, the sales attorney, the title closer, the buyers, the sellers, so forth. There's so many people at the closing table with COVID, less is more at the table. Your attorneys as a buyer will give you a list of checks that you need to get cut. Typically they need to be bank checks. So just find out what type of checks you need. They'll be specific with you. They'll give you the amounts. They'll give you almost like a closing checklist, right? And stuff like that. Now, another important thing that I know someone asks about this is closing costs. So you need the difference in the amount of your down payment as one, and then two, you need closing costs. So you're going to want to speak to your banker or your loan officer or Frank to find out how much money do you need aside in addition to your down payment, right? So say your down payment's 10%, what do you need for closing costs? Because I often see, and my first deal ever in real estate, I'll never forget, they were short on closing costs and we were trying to find every which way to figure out where they were getting this money from because it was a lengthy process. Like, how are they not going to close? Because their loan officer did not communicate to them that they needed additional money in their bank to close to bring to closing. So closing costs are something that I always say you need to plan for. Closing costs for a co-op are going to be a little bit less than a condo or a house because co-op is shares in a property, condo and a house is real property. There's a difference, and I could have a whole segment on that if we wanted to have a conversation on it. But Frank, closing costs. How does one budget for closing costs at closing?
Yeah, that's a good question. Much like anything else, closing costs are determined by the type of loan that you're taking, the type of property that you're buying, and the purchase price and down payment, right? So, a $400,000 house with $10,000 in taxes and a 20% down payment will be more in terms of out-of-pocket expenses than a $300,000 house with 20% down but 15,000 in taxes. So the best way to come up with an estimate, there isn't a percentage here. I know online and in other states you could use a 3%, a 4%, a 5% number and say, okay, that'll give me an idea of what my closing costs are. It's hard to do that here, especially in Nassau County and Suffolk County, because of how expensive the property taxes could be and how much they vary. So the best thing, once again, with communication, going back to communication, is to reach out to your loan officer and say, hey, if I made an offer on this $400,000 house and was putting down 10% or 20% with $12,000 in property taxes, what do I need to budget for? Rule of thumb, when you start looking at homes that are north of $400,000 with north of $10,000 in taxes, after legal expenses and title costs, you're always going to be between $18,000 and $20,000 in closing costs. That number will start to increase as the purchase price increases, as property taxes increase, and the amount of the loan increases, right? So if you're putting down less money and you're borrowing more money, your closing costs will be higher than somebody with the same sales price that is putting down more money. So it just goes back to communication. It takes me all 5 minutes to do a full workup for you, what we call a loan estimate or transaction summary of, hey, these are what your costs would be on this particular home in this particular loan with these particular taxes, right? And we can get real granular with it right down to within a few $100.
And that's the thing, right? Things are going to shift, things are going to move, have conversations up front. If you're not using one of our vendors who we kind of know what they charge, especially like a real estate attorney or an inspector, have conversations with your people to make sure, hey, like, what are your fees? What do you charge? Like, attorneys usually charge a flat fee, not hourly free. So like, have those conversations with your attorneys. Inspectors, see what services they offer. Like, we use inspectors that have different technology and products that could test for things that not every inspector can do, right? They'll be looking more at it at an eye surface level versus a technology level. So those things are always important. And someone did ask in like our spreadsheet of how to save on closing costs, or there programs for it. So there are things called a seller's concession, but in a seller's market, it's really, really hard to get a seller to accept a seller's concession, which helps towards closing costs. So say your offer is $500,000 with a $20,000 seller's concession, that $20,000 would come out of the seller's pocket to go towards closing costs at closing. However, when a seller has 10, 15, 20, 30 offers on the table at ask over ask, the odds of them accepting a concession is going to be slim to none. So you really, really, really want to make sure that you're in a solid position to put a strong offer in. Regarding any closing costs, Franks, are there any programs that you're aware of, like that people could apply for assistance with closing costs outside of a seller's concession?
So one of the loans that we do here at Embrace is called the Sony May loan. It stands for the State of New York Mortgage Agency. It's a first-time homebuyer loan. It is income driven. So you have to be within a certain income level to qualify. You do have to be a first-time homebuyer. They do offer a 3% DPAL, or down payment assistance loan. It's 3% of the sales price, and that money can be used towards your closing cost, right? So if you had a $400,000 sales price, you applied for a Sony May loan with us, and you checked the box that you wanted the DPAL or down payment assistance loan, it would give you an additional $12,000 to use towards your closing cost. That's really the only loan option out there that gives you the alternative to take a additional amount of money and apply it towards closing costs. Kristen mentioned earlier about a seller's concession. In this market, to get a seller to say, hey, anything my house over appraises for, I'll let you use towards closing costs. is not something that you're going to want to get wrapped up in. The likelihood of them accepting that when you're competing against multiple other offers is very, very unlikely. So the next best option would be some sort of a Sony May or a first-time homebuyer loan like Sony May that will allow for a down payment assistance loan where you could use that money towards your closing expenses.
Yeah, and these are just things that we want to educate you with because it's important to know when you're going into this, right? Like this, and we do formal buyer consults with every buyer, so it rehashes some of this stuff and then some, because we do care about you being educated as much as possible and putting yourself in the best light in this process because it's emotional, it's stressful, but we're your coaches, we're your cheerleaders, we're your support system. We're not just realtors. I feel like some days I'm a psychologist, some days I'm a therapist, some days I'm your cheerleader. And then I'm also educational at the same time. And I know Jackie K, like we all like, we're in your corner. We're there for you. And look, we have good days and we have bad days, right? Some of the days it's like we feel really winning. Some of the days we feel defeated with our clients. It's an ebb and flow process. So once your closing schedule, once your final walkthrough, you get to closing, you'll get your keys and congrats, you're a homeowner. And we're so excited for you throughout this process. You'll always hear from us. We always keep in touch. We have like so many great events planned and special events for our clients throughout the year. Our next event is March 16th. It's with a interior designer. So like we're really excited about that one because this is a new event for us to do via Zoom. But in mindful of everyone's time, I do want to open up the floor to see if any of our folks on here have specific questions for us. We know it's a lot of information. It is recorded. We could send out the recording, but what questions do you have for us? Or did we answer them all because we're that good? Anyone? Maureen, Kim, Melanie?
I think there's you had said Jeff had said about like making like money deposits. Like there's a way of like, you know, if you had cash, like you deposit it over a certain amount of time or something like that. Was it something he said?
You know, when it comes to cash deposits, it's really hard, right? So, you know, it depends how much the deposit is. You know, if it has to be sourced, it is something that becomes a real issue because there's no way to source cash deposits. So we usually try and advise our buyers to leave cash out of the transaction when they're purchasing a home. Because once again, when we start collecting mortgage documents and bank statements, we're going to go back the last 60 days. So if we do see a large deposit in there that's not consistent with your pay or your payroll check or something like that, we are required to ask where it came from. Unfortunately, when it's cash, we can't use it and then it has to be backed out of the transaction. So we do usually advise our buyers to leave cash out of the transaction when they're going to contract at that point. You know, what you guys do, you know, months before that, I guess is up to you guys.
Okay.
Is it smart to work on a budget and credit before even looking at home price range? Yes.
Absolutely.
Yes.
Absolutely.
Absolutely. Because we don't want to take you to your dream home and then it's not in your range, right? Because that's so disappointing, so discouraging, unless that's motivation for you, right? I know Jackie loves going looking at homes like way out of her league because she's like, I'm going to get this one day and it's on my vision board. And it's like since day one I met Jackie, this is what Jackie does. And that's why we adore her and love her because she has these big goals and big dreams. So definitely work on your budget and credit. If you have questions on that, definitely reach out to us, reach out to Frank. Frank, if you want to drop your contact information in the box, you know, we'll definitely send out the recap and, you know,
Sure.
you can follow all of us on social media as well. And hold on, I was told by someone that grants are available for some first-time home buyers. I assume they are rare. So Kim, there are some grants, you have to dig deep, right? Like depending on where you are, right? You have like veteran programs, then you also have some first-time home buyer programs. Every state varies, right? So if you're looking to buy in New York, New Jersey, Connecticut, so you really have to be well-versed depending on where you want to buy. I think you might have mentioned you might be looking to buy in Jersey. So we'd have to definitely connect you with a realtor in Jersey. And we have really some good friends that service North Jersey. So we could definitely connect you there. And Frank, are you aware of any grant or credit programs for first-time home buyers?
So, there are, I mean, every state has their different nonprofit organizations, right? So for New York, downstate New York, you have Long Island, you have Long Island Housing Partnership, the CDC. Sometimes the towns will do a small grant program. You just have to be vigilant. You have to kind of be on the lookout for them. Um, they're not easy, I can tell you that. I could probably count on one hand the amount of my buyers that actually have qualified and received the grant money. It is something I can tell you that you would want to start months and months and months in advance before going out and looking for homes. You don't want to be in the process of buying a home, and then go through the grant process and find out that that's going to be 6 or 8 months, because you're just going to end up losing out on that home just based upon the time frame. So I would say do your due diligence. The housing partnership, the Long Island Housing Partnership, is always a good place to start. The CDC, Community Development Corp. Sometimes you'll find organizations like that are nonprofit organizations that, whether it be income, whether it be whatever the reasons may be, they may offer or usually have some sort of grant money. I've seen $1,000, a couple $1,000 in some cases. I've had some where the Long Island Housing Partnership have offered my buyers close to $10,000 or $11,000. So be vigilant, do your homework, do your due diligence, and figure out if it's something that it's worth entertaining, and going through the steps on to see if you qualify.
Perfect. Melanie, I see your hand raised. What questions do you have for us?
Yes, hi, can you hear me?
Yes, loud and clear.
Yes.
Okay, awesome. So I don't know if this was a little too personal, but it's actually something I did hear in a podcast. So I did want to clarify. I did write down because Frank had mentioned having 2 pay stubs once you're on payroll as a W-2. I am a 1099 worker right now, and it's very sparse because I'm taking an exam. So whatever. Long story short is that I will be working for the same company that I was working for previously for 3 years before I stopped working to take this exam and to finish up school. So is there a case where, like, would it be worth it for me to speak to HR or the director of the facility to get a letter of intent, like to start, if I have a start date and stuff like that and a history with the company, would that be something that would be considered, or would you just suggest I wait till I have those actual 2 pay stubs to, move forward with the process?
Great question, Melanie. Really great question. So you are not required, like in that case, then, and that's where it kind of separates myself, like a mortgage planner, from other people. In that case, then you're not waiting for pay stubs. I would say if there's a formal employment offer letter, we definitely want to read through the terms of that, right? Does it state that you're a W-2 employee? Are you full-time? Are you part-time? It'll help me piece together your income. And on top of that, we have what we call an employment verification form that we would send out that would just detail your start date, what your salary is going to be, that you're full-time, and things like that. In those instances, you do not need 2 pay stubs to start the process.
Okay, great.
And
Thank you.
Good question. Great
that's
question.
something that, like, we hear often too, like, I'm self-employed, I'm this, I'm that. So when you are self-employed, I mean, I have an accounting degree, which most people don't know that about me. So I try to educate people as much as possible. When you are self-employed, yes, there are a lot of tax write-offs and different things. Speak to your realtor, speak to your loan officer, speak to your accountant of how to put you in the best light to make sure that you're going to get approved for a loan. Because if you write everything off and show 0 income as a self-employed employee, yeah, it's great, right? Because you have the tax write-offs, but if you show no income, guess what? You're not getting approved for a loan to buy a house, right? So there's
And have your cake and eat it too.
yeah, exactly. You want to pay taxes or you want to buy a house? It's one of
That's
the two.
it. It's
So
one of the two.
so those are some things that we like to educate you on based on experience, especially, like, whether you're buying a home or selling a home. I always try to educate people on some of the tax consequences of these things, because I am aware. Obviously, I haven't practiced like any taxes in a bit, but I have some knowledge of a foundation of what questions for you to get yourself set up with to ask your accountant before you're doing any of these transactions. Any other questions before we wrap this up tonight? I think there was a lot of information. We did record it, like I said, but I just want to make sure everyone goes home educated, excited, and ready to buy a home.
I do have one more question. In terms of, I guess, multi-family house, like buying a 2-family house, They tend to be more expensive, right? It's more, space. So in terms of like debt to income ratio, I'm wondering, do they factor in the fact that, if you have plans to rent out that house, that'll kind of increase, your income, if that makes sense? I don't know if that makes sense, but
Makes perfect sense.
okay.
That makes perfect sense. Yeah. So, what would happen is in the multifamily sector, so we'll do on the residential mortgage side, it's anything from 1 to 4 families considered a residential mortgage or a single family home or up to a 4 family. We will use projected or proposed rental income from the other side of that 2 family, right? So if we know, hey, you're going to be occupying this side, and we know that the other side, based upon the comparable rent schedule that will appear in the appraisal report, is going to go for $2,500. We'll use about 75% of that amount towards your additional income to qualify for that home.
Okay, thank you.
You're
Yeah.
welcome.
Where there's a will, there's a way with many different options. Frank's here as a resource. We're here as a resource. Any questions that you have, you need, we're always here. Kay dropped our information in the box. Make sure we have your email contact so that we can put you on our email list, invite you to future events such as the Design Your Home, Easter Bunny, Scale and Santa Experience. We're implementing a beer and wine festival. So there's a lot of fun things coming up to a town near you. So keep in touch with us, and we hope you all have a great evening. Thank you for joining us.
Thanks, guys.
Bye.